Tonight is one of those moments that tricks people. They look at a few ugly candles, they hear a few loud headlines, they watch gold and silver whip around, and they immediately think the whole story is over. That is how people get shaken out right before the market shows them what was really happening. And what's happening right now is bigger than one red hour, bigger than one green bounce, and definitely bigger than the usual noise people mistake for insight. I'm going to walk you through this carefully because the easy reaction tonight is panic, and the smarter reaction is patience. And right after this, do me one quick favor. If you get value from these breakdowns, subscribe and drop even a tiny comment like Our John AG so the algorithm knows this content matters. That small move helps more than most people realize. Now here's the part almost nobody says clearly enough. A wild market open does not automatically mean the bullish case is broken. Sometimes it means the exact opposite. Sometimes it means the market is stressed, crowded, emotional, and trying to force weak hands out before the bigger picture becomes obvious again. It does mean you need to separate short-term chaos from long-term direction, because if you mix those two things together, the market will take your confidence apart piece by piece. And that is really what this video is about. Not hype, not fake certainty, not pretending every dip is a gift and every spike is destiny. I want to show you what matters, what does not, what the latest hard data actually says, and why the long-term metal story still has real fuel, even while the short-term tape looks messy. Because there is one mistake people keep making in markets like this, and it costs them over and over again. They confuse movement with meaning. A fast move feels important. A loud chart feels important. A dramatic headline feels important. But the market does not pay you for reacting fast. It pays you for reacting correctly. And those are not the same thing. In fact, most of the damage happens when people think speed is intelligence. It is not. Sometimes the smartest thing you can do is slow the whole picture down and ask a basic question. What actually changed? Because if you ask that question tonight, the answer gets very interesting very fast. Yes, gold took a hard hit this week before bouncing. Reuters reported that spot gold fell to a 4-month low of about $4,098 on Monday, then rebounded Friday to roughly $4,492, while spot silver also bounced back toward about $69.50. That is real volatility. Nobody needs to pretend otherwise. But the same Reuters reporting also showed analysts still talking about dip buying, not a clean collapse. And that matters, because one of the laziest mistakes in financial media is this idea that if the price falls, the thesis failed. No. Sometimes price falls because people need liquidity. Sometimes it falls because the dollar firms up. Sometimes it falls because rate expectations shift. Sometimes it falls because too many fast traders got leaning the same way, and then the unwind hits all at once. Price can be emotional before it becomes logical again. That is exactly why I want to start with a rule that can save you a lot of pain. Do not let one trading window rewrite your entire understanding of the market. The open can be violent. The first hour can be theatrical. Futures can overshoot. Headlines can exaggerate. But if the deeper structure underneath the move still points to tight supply, stubborn demand, and fragile confidence in paper promises, then the bigger story is not dead. It is just being argued over in public. And right now, there are several reasons that argument is still alive. Start with the positioning data, because this is where the conversation gets more concrete. The latest CFTC futures-only report for silver, dated March 24th, showed commercial short positions at 69,799 contracts, with open interest at 113,164. People watch that number closely. It does not mean price must explode. It does mean the structure is worth paying attention to. Then, look at the vault side. CME's daily metal stocks report for March 27th showed registered silver at just over 77.16 million ounces. When people talk about pressure in the system, that is one of the numbers they are staring at. Not because every ounce disappears tomorrow, and not because every contract suddenly demands delivery, but because markets get more interesting when available registered supply looks small relative to the scale of paper interest above it. Now pause right there, because this is where people on both sides get sloppy. The overly bearish crowd looks at recent price weakness and acts like metals were exposed as a joke. The overly bullish crowd looks at every tightness signal and talks like the whole system is about to explode by lunchtime. Both groups usually miss the truth because the truth is more demanding. The truth is that market stress can build for a long time before it shows up in the clean, dramatic way people imagine. Tightness does not move on your schedule. Neither does fear. Neither does repricing. That is why conviction without patience becomes self-sabotage. And if you are watching this because you want the simple version, here it is. The market can stay rough in the short run and still stay constructive in the long run. Those two things can happen at the same time. In fact, they often do. Now let's talk about why people are so emotional around the open in the first place. Because the open is where every insecurity shows up at once. Overnight moves get judged. Dollar strength gets judged. Oil gets judged. Rate fears get judged. Every chart watcher, every futures trader, every fast money account, every retail holder with shaky nerves is staring at the same screen looking for instant confirmation. That creates a strange kind of theater, a lot of motion, a lot of confidence, not always a lot of clarity. And clarity is what matters here. Reuters said on March 26 that gold was pressured by a firmer dollar and higher oil prices, with concerns that stronger inflation could keep rates elevated longer. The same report said gold had fallen about 17% since the war began on February 28th, and spot silver was down 5% that day to around 67.71. Again, that does not tell you the whole long-term story, but it does explain why the tape has felt so unstable. So if you were looking at the chart and wondering why precious metals were not acting like perfect safe havens every second of the conflict, that is the answer. In the short run, markets do not always reward the clean textbook narrative. When yields, inflation fears, dollar strength, and forced selling all collide, even assets people trust for protection can get dumped first and understood later. And that is one of the biggest mindset traps in this whole space. People think a hedge should make them feel calm all the time. No. A real hedge protects purchasing power over a longer period. A real hedge can still be volatile. If you need your thesis to feel comfortable every single day, you are probably not holding a thesis. You are holding a fantasy. That brings me to the second layer of this story, and this part matters more than most people realize. Trust. Because underneath the daily price moves, what precious metals investors are really trading around is trust. Trust in central banks, trust in paper assets, trust in real rates, trust in the supply chain, trust in settlement systems, trust in the idea that when stress hits, the institutions standing in the middle will be strong enough, liquid enough, and honest enough to do what people expect. That trust is not exactly looking stronger right now. Reuters reported on March 26th that UBS suspended withdrawals from its Euro Invest real estate fund for up to 3 years, saying liquidity was not sufficient to meet redemption requests. The fund had about 406.8 million euros, or roughly $469.4 million, in assets at the end of February. That move followed other redemption limits elsewhere in credit markets. One event alone does not prove systemic collapse. But events like that remind people that liquidity can feel plentiful right up until it does not. And when people start seeing gates, freezes, delays, redemptions capped, or settlement worries in other corners of finance, they start asking a different kind of question. Not, what is the fastest asset? Not, what is the hottest trade? But what do I fully own? What can nobody dilute? And what does not depend on some counterparty staying healthy? That question is one reason metals still have a long life in this conversation. Now I want to slow down on silver for a minute, because silver is where people get the most confused. Gold is easier for most people to understand. It is monetary, it is defensive, it is central bank adjacent. Silver is messier. It lives in two worlds at once, part money, part industrial material, part fear trade, part growth trade. That split personality is exactly why silver can look brilliant one month, ridiculous the next month, and then dangerous right before it surprises people again. But the latest outlook is still more interesting than the doom crowd wants to admit. The Silver Institute said in its February outlook for 2026 that the market is expected to remain in a sixth straight annual deficit. It also said physical investment is forecast to rise 20% this year to about 227 million ounces, even as industrial fabrication is expected to ease 2% to around 650 million ounces. On the supply side, total silver supply is forecast to rise 1.5% to about 1.05 billion ounces, with mine production up around 1% to 820 million ounces. In plain English, supply may improve some, but the market is still not swimming in easy metal. And notice what that means. It means the bullish case does not have to rely on cartoon thinking. You do not need to believe some fantasy where every vault is empty tomorrow. You do not need to believe every dip is manipulation and every rally is destiny. You just need to understand that a market can remain fundamentally tight, even if it is not in immediate emergency mode. That is enough to keep the longer-term case alive. Especially when physical investment starts rising again, at the same time broader confidence feels shaky. And there is another piece here people keep underestimating: industrial relevance. The Silver Institute's outlook specifically said data centers, artificial intelligence-related technologies, and the automotive sector are expected to support silver use across multiple industrial end markets, even as solar demand faces more thrift and substitution. That does not mean industrial demand grows in a straight line. It does mean silver still has real economic uses beyond the usual fear trade narrative, and those uses matter when investors start asking which assets sit at the intersection of money and industry. Now let me say something that might save a lot of viewers from making the same bad decision at the same time. Do not build your whole view from one slogan. If you only believe silver is GGK to the moon tomorrow, you will get punished. If you only believe silver is dead because it pulled back hard, you will also get punished. The mature way to look at this market is less emotional and more durable. You respect the VGK. You respect the possibility of more downside swings. You respect that macro pressure can hit again. But you also respect the data that keeps saying the physical side of this story has not simply vanished. GDK is the story. There is also a policy angle here that people should not ignore just because it sounds small at first. Georgia's SB 424, called the Transactional Gold and Silver Act, passed the Georgia Senate on March 6th and moved to the House, where public tracking showed it reaching House second readers on March 10th. Whether that bill becomes law or not, the point is bigger than one state. When lawmakers start revisiting how gold and silver could function in actual transactions, it tells you the monetary debate is no longer stuck on the fringe. And think about what that means psychologically. Ordinary people do not spend time debating gold and silver payment systems when they feel perfectly comfortable with the direction of money. Those conversations get louder when trust gets thinner, when inflation feels more personal, and when the gap between official reassurance and daily experience gets wider. So even if you never use metal in a transaction in your life, the fact that the debate is growing tells you something about where public confidence is drifting. There is also the liquidity argument from the gold side, and I think it deserves more attention because it explains a lot of the recent confusion. Sprott strategist Paul Wong said this week that gold's March sell-off looked more like a liquidity crunch than a breakdown in fundamentals. Reuters captured a similar idea when it quoted analysts saying the search for liquidity had fueled sales of both gold and silver during the conflict. That is important because a liquidity-driven drop feels bearish in real time, even when it does not destroy the bigger investment case. That is why experienced viewers do not ask only one question. They do not ask, did price fall? They ask, why did price fall? Who was forced to react? And what stayed true underneath the move? If the answer is mostly dollar strength, rate pressure, macro stress, and liquidity demand, then that is painful, but it is not the same thing as saying the whole reason for owning metals vanished overnight. And one more thing before we close this out. A lot of people love the idea of owning physical metal, but they still shop for it the wrong way. They chase the lowest premium, trust random marketplaces, and act like sealed packaging is a guarantee. It is not. Weight matters. Dimensions matter. Conductivity testing matters. Dealer reputation matters. If a seller cannot explain what they test and how they test it, that is not a minor detail. That is the detail. In a market built on trust, verification is not paranoia. It is basic discipline. And while people are distracted by the hourly noise, the broader macro backdrop keeps getting stranger. Take helium. This might sound unrelated until you think about what it really signals. Reuters reported this week that the Middle East conflict has already started affecting helium supply, with executives warning that tech supply chains are being hit. Reuters also reported that Qatar-related disruptions led to short-term helium shortages, and Air Liquide said it would reallocate supply from other parts of the world. Bloomberg separately reported Airgas declared a force majeure event and warned some customers they might receive only about half their normal monthly helium deliveries. That is not a silver headline on the surface, but it is a reminder that modern supply chains do not fail one industry at a time. Stress jumps sectors. Why does that matter for metals? Because a lot of the precious metals thesis is really a thesis about fragility. Fragility in energy, fragility in transport, fragility in manufacturing, fragility in confidence, fragility in the idea that the system always has more slack than it appears to have. When another industrial input starts looking tight, it reinforces the feeling that this is not a calm, well-cushioned world. It is a world where disruptions travel. That does not mean every disruption is automatically bullish for gold and silver. It does mean the market environment stays vulnerable to shocks. And vulnerable environments keep the case for hard assets alive. Now add one more layer: currency symbolism. The U.S. Treasury announced on March 26th that President Donald Trump's signature will appear on future U.S. paper currency. That is a symbolic story more than a supply story. But symbolism matters in markets because money is not only math, it is belief. The more public attention shifts toward the nature of money, who controls it, and what backs confidence in it, the more precious metals re-enter the conversation. Not because paper currency disappears tomorrow, but because people start asking old questions again. And once those old questions come back, people start thinking differently about physical ownership. This is where I need to say something very plain. There is a huge difference between liking a chart and owning something real. I am not saying one replaces the other for every person. I am saying they are not the same kind of exposure. A futures trade is not the same thing as a coin in your hand. An ETF share is not the same thing as direct possession. A paper gain is not the same thing as no counterparty risk. People blur these lines when markets are calm. They stop blurring them when stress shows up. That is also why authenticity matters so much in this space, because if trust is already thin, fake metal becomes an even uglier problem. The counterfeit issue is not some niche side story anymore. Too many buyers still assume a nice listing, good photos, or sealed packaging means safety. It does not. Visual trust is not actual verification. A fake can look clean. A fake can sound convincing. A fake can come with a story. That is why buyers who want physical exposure need to think like adults, not gamblers. Test what you buy. Use reputable dealers. Do not let a cheap price talk you into an expensive lesson. And let me make this personal for a second. A lot of people watching videos like this are not giant investors. They are regular people. They are trying to protect savings. They are trying to learn. They are trying to avoid being the person who bought the wrong thing at the wrong time from the wrong source. That matters. Markets are hard enough without adding fraud on top of volatility. So, if you are one of the viewers who has already built good habits and protected yourself well, share your success story in the comments once in a while. It genuinely helps newer people keep their standards high. Now, I want to come back to the part that creates the most confusion, and that is the phrase people keep repeating every time metals wobble. The fundamentals changed. Did they really? Let's test that honestly. Did silver positioning suddenly become irrelevant? No. Did registered silver on COMEX suddenly become abundant and boring? No. Did the market suddenly stop running structural deficits according to the latest industry outlook? No. Did geopolitical stress suddenly vanish? No. Did supply chain pressure suddenly become a fiction? No. Did the financial system suddenly become more liquid and more trustworthy because one bounce or one drop happened? No. So what changed? Mostly sentiment. Maybe some fast money got pushed out. Maybe the dollar pushed harder. Maybe inflation fears and higher for longer rate expectations hit metals in the short run. Maybe traders who came in late got punished. That is not nothing. But it is also not the same thing as a broken long-term case. And that distinction right there is where disciplined viewers separate themselves from emotional viewers. Because emotional viewers want every move to confirm what they already wanted to believe. Disciplined viewers let the market be messy without letting their thinking become messy too. That is harder, but that is what survives. Now, I also want to address the loudest narrative in this whole space, because I think a lot of people handle it badly. Manipulation. Here is the grown-up version. Yes, there is a real history here. Major banks were fined over spoofing in precious metals markets, and that history matters. It is not crazy for people to remain skeptical about how paper markets behave. But once that skepticism turns into an all-purpose excuse for every candle, it stops helping you. It becomes intellectual junk food. You do not need to say every drop is some shadowy attack. Sometimes a drop is just liquidation. Sometimes it is margin pressure. Sometimes it is a stronger dollar. Sometimes it is rate fear. Sometimes it is overcrowded positioning getting cleansed. Sometimes it is several of those at once. If you call everything manipulation, you stop learning. And if you stop learning, the market can fool you using your own favorite story. That is why I prefer a calmer framework. Respect the history. Respect the possibility of pressure around key times. Respect the paper structure. But do not replace analysis with slogans. Slogans make you feel smart while the market quietly empties your conviction out from underneath you. And since we are talking about maturity, let me give you one more rule. Do not confuse a live market stream with a complete thesis. The open is one chapter, not the whole book. The overnight move is one clue, not the verdict. The first hour is where emotions show up. It is not always where truth settles. That matters more than people realize, because many bad decisions come from turning a temporary scene into a permanent conclusion. Now, I know some of you are thinking, fine, but what happens next? That is the question everybody loves, because it sounds practical. But the honest answer is not one line. In the very short term, metals can stay jumpy. Gold and silver are still in a macro environment where the dollar, oil, and rate expectations can keep throwing punches. That means more violent swings are possible. I would not pretend otherwise just to sound bullish. But in the medium term, if the current ingredients stay on the table, tight physical attention, rising investment interest, persistent geopolitical stress, and fragile confidence in paper systems, then the market does not need perfection to stay interesting. It just needs the bigger worries to keep simmering. And right now, they are still simmering. Reuters reported Friday that spot gold climbed back to about $4,491 and spot silver to about $69.54 as dip buyers stepped in, while Commerzbank raised its year-end gold target to $5,000 an ounce. Again, that is not destiny. It is just another reminder that after all the selling, serious people still do not seem ready to declare the hard asset story finished. That is why the cleanest way to think about this market is not with certainty, but with structure. Structure says metals can stay volatile and still remain strategically important. Structure says a pullback can cleanse excess without killing the theme. Structure says not every bullish argument is silly, and not every bearish argument is malicious. Structure says you watch the data, not the loudest personality. And structure says the people who do best in markets are often the ones who can live without instant emotional closure. Because that is what everyone really wants, right? They want the market to tell them immediately that they were right. It almost never works that way. The market usually makes you sit with uncertainty first. It usually makes you prove your patience first. It usually makes you feel a little stupid first. Then, if your thesis was built on something real, it starts making sense again. That is why I think the next big mistake many people will make is not buying too late or selling too early. It is reducing this whole story to entertainment. The memes, the shouting, the dramatic thumbnails, the wild countdown energy, the constant obsession with every tick, that stuff can be fun. I understand why people enjoy it. But if that becomes your whole framework, you are no longer analyzing. You are consuming adrenaline. And adrenaline is not a strategy. A real framework is slower. A real framework asks whether the latest data fits or breaks the thesis. A real framework checks positioning, inventories, supply, macro pressure, and trust. A real framework can survive a bad day. A real framework can survive being temporarily uncomfortable. And if you want to know whether a market view is strong, that is the test. Can it survive discomfort without turning into denial? If yes, it is probably real. If no, it was probably just excitement wearing a serious mask. Now, before I land this, I want to make room for one more thing people rarely talk about enough. Community standards. Not blind agreement, not cult behavior, standards. Because markets like this attract two kinds of people. The first group wants to learn, compare notes, and get better at staying calm. The second group wants constant validation and instant emotional payoff. The first group lasts longer. So let's build for that first group. If you have been successful in this space, whether that means building a stack carefully, avoiding scams, or just staying disciplined when everyone else was losing their mind, share that with people. Quiet wins help other viewers more than loud predictions ever will. And yes, by the time you are watching this, the members-only video should already be up. That is where I put the more in-depth follow-through in one place, so serious followers can see the full update without hunting through scattered clips. That is also the easiest way for me to tell who is really staying locked in with the bigger picture. So let's bring this all together. Gold and silver got hit hard, then bounced. The dollar and rate fears clearly mattered. Commercial silver shorts are still sitting at a level people are watching closely. Registered silver on COMEX is still relatively lean. The latest industry outlook still points to another annual silver deficit, even with some supply growth. Investment demand for physical silver is expected to rise this year. Liquidity stress in other markets is still showing up. Helium and energy disruptions are reminding everyone how quickly supply chains can get weird. And the broader trust question around money, paper promises, and real ownership is not going away. That is not a dead market. That is a contested market. And contested markets are where people lose perspective. So here is the practical takeaway. Do not let short-term violence bully you into long-term confusion. Do not let narratives do your thinking for you. Do not buy because someone yelled. Do not sell because a candle scared you. Build your view from what is actually changing. Then, give that view enough time to either prove itself or fail honestly. That is how adults handle a market like this. And that is how you stop getting emotionally dragged around by every open. So now I want to hear from you. What matters more to you right now? The short-term chart or the long-term physical story? And what is the one signal you are watching most closely over the next week? Because this is one of those moments where the loud crowd can easily get it wrong. And if we are careful, patient, and honest about the data, that can become an advantage. Stay sharp. Stay steady. And if this breakdown helped you cut through the noise, subscribe before you go. It takes 1 second, and it tells me to keep building these simple, high-signal updates for people who actually want substance instead of chaos. That is why patience matters more here than prediction, and discipline matters more than drama.